Right now, the biggest banks on Wall Street are quietly drawing a line in the sand on silver, and that line sits far above where silver is trading today. What's more interesting is where that line comes from. Not from hope, not from speculation, but from math that has repeated itself in some form multiple times across the last 50 years. This week, silver has been trading around $57 to $58 an ounce. That is a brutal 47% fall from its all-time high of 121.64, reached just 5 months ago in January. And right now, in this exact moment, while panic is spreading and retail investors are rushing to sell, the research divisions at JPMorgan, Goldman Sachs, Citigroup, and Bank of America are all pointing their models in the same direction. They see silver significantly higher, every single one of them. The disagreement is not whether silver goes up, it is how far. Before I show you what those banks are projecting, and before I walk you through the honest math behind the most aggressive call on Wall Street, I want to ask you something directly. Do you believe this drop in silver is the beginning of the end of the story, or a painful chapter inside a much longer one? Think about that as we go, and tell me in the comments, because the answer you land on will determine how you interpret everything I'm about to share. Let me start with what actually happened, because understanding the cause of this crash is the single most important thing to understand before you make any decision about silver right now. Silver hit $121.64 per ounce on January 29th of this year. That was not just a record, it was the highest nominal price in the entire recorded history of the silver market. Silver surged over 147% in 2025 alone. What followed that peak was not a gradual correction, it was a collapse. And the reason behind it tells you almost everything you need to know. In mid-June, the Federal Reserve held its first major policy meeting under the new Fed chair, Kevin Warsh. Warsh came in with a reputation for hawkishness, and he delivered on it. The Fed's updated projections raised its inflation outlook. The headline PCE inflation reading for May came in at 4.1%. Markets immediately began pricing in not one, not two, but 3 potential rate hikes before year-end. The probability of a September rate increase jumped to around 62%, and the US dollar surged to its highest level in over a year. When that happened, silver fell nearly 10% in a single week, and it was already falling before that. Here is why those two forces, a stronger dollar and rising rate expectations, hit silver harder than almost any other asset. Silver pays you nothing while you hold it. No dividend, no coupon, no interest. So when bond yields rise and cash suddenly becomes more rewarding to hold, money exits silver quickly and moves into yield-bearing assets. At the same time, a stronger dollar makes silver more expensive for buyers in every other currency. So demand from outside the United States shrinks. Both forces arrived at the same time, and silver absorbed the full weight of both. And crucially, gold suffered the same week. Gold, which was trading near $5,000 earlier this year, has now pulled back to around $4,050 to $4,090. When everything in the precious metals complex falls together on the same week of a Fed decision, that is not a silver problem. That is a macroeconomic wave rolling through the entire sector simultaneously. The price of silver fell. The reasons to own silver did not. That distinction matters more than almost anything else you will hear today, and it is exactly what the banks are looking at. But this is where the story becomes more interesting, because underneath the fear and the falling price charts, there is a structural picture for silver that has been quietly building for 6 years, and the Fed cannot touch it. The Silver Institute published its World Silver Survey 2026 in April. The findings are striking. The global silver market is now entering its 6th consecutive year of supply deficit. That means for 6 straight years, the world has consumed more silver than it has produced. In 2026, that shortfall is projected at 46.3 million ounces. That is wider than the year before. And since 2021, the cumulative draw on above-ground silver stocks has exceeded 760 million ounces, over 750 million ounces taken from finite existing supplies. A Fed rate decision does not put any of that metal back. To understand why this matters so much, you have to understand where silver actually goes when it leaves the ground. The dominant narrative about silver for years was solar panels, and that part of the story has genuinely shifted in 2026. When silver prices surged toward $120, solar manufacturers had a powerful incentive to use less of it per panel. That process is called thrifting. It means engineering the same panel output from a smaller amount of the metal. According to the Silver Institute, solar demand for silver fell 6% in 2025 and is now projected to fall another 19% in 2026, from 186.6 million ounces down to roughly 151 million ounces. So the honest version of the silver story has to include that number. The single largest industrial customer for silver is actively reducing its consumption. That is a real headwind, and anyone who ignores it is not giving you the full picture. But here is the part most people are not tracking. Even with that 19% solar reduction fully accounted for, the silver market is still projected to run a deficit in 2026. Not a narrow one, a deficit that is actually wider than 2025. The market is losing its biggest growth engine and the shortage is getting worse, not better. Why? Because mine supply is contracting at the same time. Approximately 75% of all silver mined globally comes as a byproduct of mining for other metals: copper, gold, zinc, and lead. That means when silver's price moves, miners cannot simply flip a switch and produce more. Production timelines for new mines run 7 to 15 years, so supply is essentially locked in place regardless of price. And the largest primary silver producer in the world, Fresnillo, has already cut its output guidance for 2026. 3 demand pools are growing to partially replace what solar is reducing. Electric vehicles now use between 25 and 50 grams of silver per car, primarily in battery management systems, switches, relays, and charging circuitry. AI data centers are expanding at a pace that requires enormous amounts of silver-intensive computing hardware and power infrastructure. And global grid upgrades, the physical infrastructure required to connect renewables, charge EV fleets, and power data centers, are running at multi-decade highs. Silver is in every transformer, every switchgear unit, and every high-speed transmission contact point where conductivity cannot be compromised. These demand sources do not buy silver because they like the chart pattern. They buy it because their products stop working without it. If you found this breakdown useful so far, this is the moment I'd ask you to consider subscribing. Not because of a number on a screen, but because markets like this one, where the noise and the fundamentals are pointing in completely different directions, are exactly where having clear, research-grounded analysis on your feed matters most. Hit that button and the notification bell so you catch every update as this story unfolds. Now let me give you the bank numbers, because this is where the institutional picture becomes very hard to ignore. Every major bank that publishes silver price research currently has a year-end target above where silver is trading today. Not some of them, all of them. HSBC raised its silver forecast and now projects an average price of around $75 per ounce for 2026. Remember, silver is trading near $57 to $58 right now. Even the most conservative major bank call on this list represents a significant move from here. JPMorgan, the largest bank in the United States, projects silver averaging around $81 for the year. In a research piece titled, "How Will Silver Prices Fare in 2026?" JPMorgan's commodity strategist Greg Shearer highlighted what he called a very tight physical market, driven by years of structural deficit combined with investment demand. He noted that silver demand has been outstripping supply by 100 to sometimes 250 million ounces per year in recent years. Goldman Sachs projects silver in the $85 to $100 range for 2026. Goldman explicitly frames silver as a primary strategic metal of the green energy transition, not just a precious metal hedge. They see it as essential infrastructure for the next decade of energy. Citigroup carries a second half 2026 target of $110, citing what it calls an acute physical shortage of silver available for delivery. That language from a major bank's research desk is significant. When institutions talk about physical availability constraints in a commodity, it tends to come before sharp price movements. So before we even get to the most aggressive number on Wall Street, let the range of mainstream institutional views settle in. HSBC at $75, JPMorgan at $81, Goldman Sachs at $85 to $100, Citi at $110. Every number significantly above today's price, and notably, every bank arrived at these projections when silver was trading much higher than it is now. The recent crash did not break their thesis. It widened the gap between where they think silver is going and where it currently sits. Now let me show you the number I opened with, the one from Bank of America, and I am going to be direct with you about what it means and what it does not mean, because honesty here is the entire point. Bank of America's head of metals research, Michael Widmer, has outlined a bull case scenario in which silver could reach between $135 and $309 per ounce. When you're staring at a $57 price, $309 sounds like fantasy, and I am not going to pretend that it doesn't. So let me walk you through the actual math, because the mechanics are more grounded than the headline number suggests. The calculation is built on something called the gold to silver ratio. It simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Currently, with gold trading around $4,050 to $4,090 and silver near $57 to $58, that ratio sits at roughly 70 to 1. That means it takes about 70 ounces of silver to buy 1 ounce of gold. Historically, this ratio moves in very wide cycles, compressing sharply during precious metals bull markets when silver catches up to gold's earlier gains. Here is how Bank of America builds their scenarios. In 2011, the last major silver bull run, the gold to silver ratio compressed to around 32 to 1. If gold stays near its current level of $4,050 and the ratio compresses to that 2011 level, silver would trade around $127 per ounce. That is the base case, and it is built on a ratio move that has actually happened before within living memory. The extreme case reaches back further. In 1980, during the famous Hunt brothers squeeze, the gold to silver ratio hit as low as 14 to 1. If that ratio repeated at current gold prices, silver would approach around $290 per ounce. Now, here is where I want to be completely straight with you. Earlier in 2026, when Bank of America framed this analysis, gold was trading near $5,000. At that level, the base case math produced $135. At current gold prices near $4,050, the same 32 to 1 compression produces a number closer to $127. The target moves with gold. If gold recovers toward $5,000 and beyond, the silver targets rise proportionally. If gold stays here, they are lower. The ratio compression thesis depends on two things happening: gold staying elevated and the ratio compressing. Neither is guaranteed. What the part most people are ignoring is this. Even a partial compression of that ratio, say from 70 to 1 toward the long-run historical average of 60 to 65 to 1, at current gold prices, would put silver in the $63 to $68 range. That is above today's price before any new catalyst arrives. The full bull cases require a bigger move. But the direction is clear, and the math is transparent. So let me now tell you what the smart money has actually been doing with real capital, not what they've been saying. Even through the sharp correction from January's highs, physical investment demand for silver is on track to rise roughly 18% in 2026, reaching its highest level since 2022, according to the Silver Institute. That means while the price has been falling, the volume of actual silver being purchased by investors has been going up. Those are two very different signals. One tells you what the paper market is doing under macro pressure. The other tells you what investors who believe in the physical case are choosing to do with their money. Institutional players have also been taking physical delivery from exchange warehouses rather than rolling paper contracts. This is a more expensive and operationally complex choice, and serious investors do not make it without conviction. When large money goes to the effort of pulling real metal out of a vault, it signals that they want ownership of the physical asset before the price moves. On the supply side, the stress is visible in company reports. Fresnillo, the world's largest primary silver producer, has cut its 2026 output guidance. The largest silver miner on Earth is producing less into a market that is already in structural deficit for the 6th straight year. That combination of falling mine supply and rising investment demand into a market that cannot physically meet needs from new production is the engine the banks are watching. But every serious analysis of silver has to confront the risks, and I'm going to give you 3 of them directly, without softening. The first risk is the Federal Reserve. The same force that crashed silver is the force that could keep it down. If PCE inflation, which came in at 4.1% in May, does not meaningfully cool in the coming months, the case for Fed rate hikes becomes stronger. Markets are already pricing in roughly 3 hikes this year. A 4th would be a significant surprise. A higher for longer interest rate environment with a persistently strong dollar is genuinely bad for silver in the near term. Anyone who tells you silver cannot go lower from here is not being honest with you. It could. The second risk is silver thrifting accelerating into full substitution. There is a meaningful difference between those two things. Thrifting means using less silver per unit while silver remains essential. Substitution means replacing silver with a different material altogether. In solar, copper paste technology is advancing. Companies like LONGi Green Energy in China are targeting mass production of copper-based solar cells as early as mid-2026. If that adoption curve accelerates and proves reliable at scale, the case for solar silver demand weakens significantly. The industry consensus is that reliable mass adoption of copper substitutes in the dominant TOPCon cell architecture is still 2 to 4 years away. But technology can surprise you, and this is a real bear case that deserves to be on your radar. The third risk is timing. Even if every one of these bank forecasts proves correct over a multi-year horizon, being early in a volatile market is its own form of being wrong if you are not prepared for it. Silver could stay under pressure for months while the Fed narrative plays out. The question is whether the people watching this have the financial and psychological runway to hold a position through that kind of timeline. So what do you watch to know when the tide might be turning? There are 3 indicators worth tracking carefully, and you do not need to be a professional to follow them. The first is inflation data, specifically the PCE index, which is the Federal Reserve's preferred gauge. If that number comes in below expectations for 2 or 3 consecutive months, the 3-hike narrative starts to crack. Rate expectations are fragile in both directions. They moved fast in June. They can move fast in the other direction too. The second is oil prices. Oil is one of the most direct inputs into inflation, and the US-Iran peace deal that was recently signed has already brought oil back toward pre-conflict levels. If oil continues to cool, it reduces inflation pressure, which reduces the Fed's room to hike, which reduces the upward pressure on the dollar. That is the chain of events that would most quickly change silver's short-term trajectory. The third is the US dollar index. If the dollar stalls at its current 1-year high and begins rolling over, that is often the first signal before precious metals find a floor. Watch the dollar before you watch silver. The dollar is the weather vane. Now let me pull this all together because the individual pieces only really make sense when you see them as one picture. Silver crashed from $121.64 in January to around $57 to $58 today. That is a 47% fall driven by one thing: the Federal Reserve's hawkish turn and the dollar strength that followed. Gold fell in the same period. Every precious metal fell together. That is a macro wave, not a silver-specific breakdown. Below the surface of that price drop, the structural story not only held, it deepened. 6 straight years of supply deficit. A projected shortfall of 46.3 million ounces in 2026, wider than the year before. Over 760 million ounces drawn from above-ground stocks since 2021. Mine supply that structurally cannot respond to price signals because 75% of silver is a byproduct of mining other metals. And a physical investment demand picture that is rising, even as paper prices fall. The banks have done their homework on all of this. JPMorgan at $81, Goldman Sachs at $85 to $100, Citigroup at $110, and Bank of America's base case built on the 2011 ratio compression, pointing toward $127 and beyond if gold recovers toward its earlier highs. Not one of them sees silver lower. Then there is the historical pattern that underlies all of it. In every major precious metals cycle, gold moves first. It gathers institutional attention, central bank buying, and safe haven flows. Silver lags, stays quiet, sometimes sells off sharply as it did this week. And then, in the later stage of the cycle, silver closes the gap, and historically closes it violently. In 2011, gold gained around 80% over 18 months. Silver tripled in the same window. The relationship is not coincidence. It is the mechanics of a smaller, more volatile market repricing after the larger market has already moved. Gold already made its historic move, reaching toward $5,000 earlier this year. Silver is still sitting down here at $57, beaten down, underperforming gold by an enormous margin in the correction. That is precisely the setup that has historically preceded silver's biggest moves. History does not repeat exactly, but the structure is familiar. What does all of this mean for the person watching right now who is holding silver and feeling sick about the price? Or for the person watching who has been waiting for a better entry and now sees $57 on the screen? If you already hold silver, ask yourself one question honestly. Did the reason you bought it change during this crash? The physical shortage is still there. The industrial demand structure is still there, even with solar thrifting. The banks are still pointing higher. The historical pattern is still intact. If your original thesis was built on those fundamentals, the price falling does not mean the thesis broke. It means the position went on sale. If you are thinking about buying, understand that timing the exact bottom is something nobody can reliably do. The professional approach in volatile markets is not to put everything in at one price, hoping you are right to the day. It is to build a position gradually. Buy a portion now, keep reserves for the possibility of lower prices, and add over time as the picture clarifies. That way you participate in the recovery without betting the entire outcome on a single entry point. And for the long-term holder, there is one more thing worth keeping in mind. Paper silver, ETFs, and futures contracts can be pushed around by the very macro forces we have been discussing. They can be settled in cash. They move with sentiment. Physical silver, the actual metal, cannot be margin called, cannot be diluted, and will not be affected by a paper market sell-off in the same way. When the banks talk about a physical shortage, they mean the actual metal. And the actual metal is what the long-term case is built on. The short-term belongs to the Federal Reserve and the dollar. That is real, and it could push silver lower before it stabilizes. The long-term belongs to the structural forces. 6 years of deficit, an industry that runs on the metal, supply that cannot quickly respond, and the historical tendency of silver to make up for its lag in a decisive and sometimes sudden way. Both are true at the same time. The question is which horizon you are operating on, and whether you have the clarity to see past the noise of a week like this one toward the picture the banks and the data are pointing toward. Now I want to hear from you. After everything you have seen here, do you think silver at $57 is closer to the bottom of this story or the middle of it? Give me your honest read in the comments. The people who watch these videos have sharp instincts for this market, and that conversation is often more valuable than the video itself. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in.